Yes, hello everyone. Thank you so much for keeping it with us. Once again, we want to look at another content of accounting. Now we are in financial reporting, how we report financially, or how we give results as accountants. So today we want to look at the income statement, and then later we shall look at the balance sheet. So income statement is sometimes referred to as the statement of financial performance or the profit or loss account. So we want to see a financial statement that shows the financial performance of an entity. So we are going to start by looking at the elements of the income statement, or the elements of the statement of financial performance. Now one is incomes. So now income refers to increase in economic benefits during an accounting period in the form of inflows or maybe increase of assets. So if, for example, money comes in, inflows, cash inflows, or if our assets increase, then that shows that an entity has received income. Now, when do we recognize income in the book? It is only recognized in the statement of financial performance only if an increase can be measured reliably. So if an asset can increase and that increase can be measured in terms of money, therefore that income must be recognized in the statement of financial performance. Two, that the future economic benefits arises from an increase in the asset. If, for example, the increase in an asset, and when we talk of an asset, we have forms of assets, we looked at them earlier. We have current assets and non-current assets. So any increase in any could be cash, increase in cash, because cash is a current asset. If, for example, the future economic benefit will accrue from an increase in that asset accrue to the company, or it will lead to the reduction of liabilities, then that income must be recognized in the financial statements. And here specifically we are talking about the statement of financial performance or the income statement. Another item or another element of the income statement, we have expenses. And expenses by definition represents decrease in economic benefits during the accounting period in form of outflows or depletion of assets. So if assets decrease, it could be cash. If cash at hand is increasing, it means there is a certain expense that is being incurred. For example, we pay salaries using cash at hand or using cash at the bank. Then cash must reduce. So cash is reducing because of an expense. Or you could be having a non-current asset, for example, motor vehicle. So if a motor vehicle loses value, then there is evidence of depreciation. And of course, depreciation must be quantified for reporting purposes. So that is an expense also. So by definition, an expense represents decrease in economic benefits in form of outflow or depletion depreciation of assets. So now, when we are practically preparing the income statement, there is a certain formula that was stipulated by the International Accounting Standard 1. There is a standard format that you must follow. And now, let us look at that standard format. For a company that is dealing in goods and services, buying and selling of goods, then this is the format. Later, we shall look at a company or a business that is dealing in services only. The question is, does it income statement or the statement of financial performance look like the one that is dealing in buying and selling of goods? The answer is no. They are different. So we shall see which items do we exclude, which items do we include. We shall see in another session, specifically look at entities that are dealing or that are selling out services only. So this one, we start with revenue or sales. Let me be specific here. Revenue or sales. Now, if you look at sales you made in a year, you remember last time we are looking at ledgers. How we record information in ledgers. So if you have sales ledger or an account for sales, and you balance it at the end of the reporting period, what is the balance brought forward? Or what is the balance carried down? So that balance is what you take to the trial balance, and this is the sales figure that you bring here. Then cost of sales. In cost of sales, we have you get the opening stock. Then, but before you got cost of sales here, maybe I can put it here. Here you can raise sales returns. Raise sales returns. Sales returns reduce what? Reduce sales. The figure must be first here. So now, after raising sales returns, you get net sales. Then on that, you raise cost of sales. When you see me putting X in a bracket, I am simply showing you that is a figure we are raising. That is a negative. So in accounting, we don't put a negative, we put the figures in brackets. So now that one, you raise cost of sales. In cost of sales, we get opening stock. Then on that, you add the purchases. Then on that, you raise purchase returns. Then on that, you add back the carriage inwards. Then on that, you raise the closing stock. The figure you get amounts to cost of sales. That is the figure you'll bring here as cost of sales, and you raise it from net sales. Then when you raise it from net sales, you will get what we call the gross profit. The gross profit. Now, on that gross profit, you add other incomes. If other incomes are there, maybe the business got some other incomes from, let's assume, contract revenue. You add. Maybe there was a disposal and the net registered again on disposal. It comes under other incomes. Then after you add to gross profit, the figure you get is called the gross incomes. Now, on that, of course, you less expenses, depending if they have, if the company or an entity has distribution costs, you include, you put it there. It has administrative expenses, you put operating expenses, you put depreciation if they are reporting isolated line items, you include each and every expense. Then you total up the expenses here and you less them from the figure we got here of gross income. What you get is referred to as profit before interest and tax, or it is called profit, operating profit. I want you to note these words. Operating profits or profit before interest and tax. We got operating profit or PBI, profit before interest and tax. Then on that we raise finance cost. Finance cost, members, those who are watching the video, finance cost is also referred to as interest expense. So if you have interest expense, you raise it there for the operating profit. Automatically, after raising the interest cost or the finance cost, you get what we call the profit before tax. Then on that, you raise income tax expense. Depending in which country you are, I don't know. If you are Kenya, I don't know how much they charge as income tax expense. If you are in Nigeria, I don't know if you're in Uganda. In Uganda, it is 30%. If you are in Congo, I don't know how much. But the standard is international, in accordance with the International Accounting Standard 1, preparation and presentation of financial statements. So you raise tax expense and what you get is the profit for the year or net profit. Net profit. Profit for the year or what we refer to as net profit. So good, that is the format. Now we want us to look at a pragmatic example. A practical example. I want us to look at a practical example. Now, we have an example here. Roger Jones. They are given a trial balance. And I want to see how to deal with it. The balance is given to us. Want to see how we can deal with it. Now, they are giving us property at cost. The figure is given here, $120,000 on debit side. Then equipment also, the figure is given to us. They are given accumulated depreciation as at 1st June. The figures are given. For property 20,000, equipment 38,000, purchases 250,000, sales 402, 200, inventory at first. At this, as at the start of the year. So this one is the opening inventory or opening stock. The figure is at 50,000. Returns out. These are purchases returns. 15,000. Wages, these are expenses, 58,800. Selling expenses, 22,600. Loan interest, this is finance cost. We have just mentioned it. 5,100. Other operating expenses, 17,700. Then we have trade accounts payable, 36,000. Trade receivable, 38,000. That is an asset. Cash at hand, an asset. Drawings. Then we have bank 17% long-term loan, and then lastly we have capital. Both sides are balancing. Both the sides are balancing. Now, we are going now to look at the additional information. The following additional information about 31st May is available. Inventory as at the close of the business has been valued at 42,000 US dollars. Depreciation for the year ended has still been charged as follows. Property charged at 1.5% per annum. Then equipment is at 25% per annum. So 1.5 for property using straight line method. I think if you have not looked at how we charge depreciation or the methods of depreciation, you can look at our previous videos. We discussed depreciation and the methods of computing depreciation at length. Therefore, I want to implore you to go and watch those videos, and then we see how we can move at some case. So this one, 25% equipment, they are telling us to use the reducing balance method. Good. So now we can start. Our emphasis, we want to look at the income statements. And then later we shall use the same question to prepare the balance sheet or the statement of financial performance. Now let us start. We are going to use the format as we have seen. Thereby we say that we start with sales and then less sales returns. Then less sales returns. The figure for sales is here on credit 402, 205, 200. So I will come here. I put this figure 402, 200. Those are my sales. You are watching us. Then on that we said you raise sales returns. Now let us see, do we have sales returns from our question? Let us see if we have sales returns. We don't have. Therefore, we just ignore that item and we now raise we erase cost of sales. Cost of sales. Cost of sales, we said that you get the opening stock. The opening stock. Then on that you add purchases. You add purchases. Then on that you add the carriage in words. Carriage. This is transport. Mhm. That erase purchase returns. Purchases returns. Then on that you erase closing stock. Erase closing stock. What you get goods, the cost of goods, available for sale. Mhm. Available for sale. Cost of goods available for sale. Good. So we are just going to feed it. Now that we have created the template, we are going to fit in. So now I want to see what is the cost of the opening stock. And the opening stock is given to us here at is 50,000. So I will come here and I record 50,000. 50,000. Then here, purchases, we shall go back to the question and see how much. Purchases 250. The purchases figure is here. 250,000. So I will come here and I record 250,000. Carriage inwards. We have carriage inward. In this question, we don't have. But if it is there, you add it. But we have purchases returns here for 15,000. So I will come here and I record. So we are going to consider this as purchases returns 15,000. Remember we are racing, so you put it in brackets like that. Then closing stock, we saw it in the additional information and they told us that the closing stock is 42,000. So you'll come here and raise 42,000. Good. So if you can go to your calculator, you get 50 as 250 minus 15 minus 42. What do you get? My calculator is telling me that you get 243. 243,000. So we are seeing that figure from the figure for sales. This one up here, 402, we are raising this figure here. So we are going now, when we raise that figure, we get the gross profit. Gross profit, if we get 402, 200 minus 243 thousands. You get, on my calculator, I'm getting 159, 200. Work it out on that side, and then we see if we can harmonize. So that is the gross profit. The question is, from the template, do we have other incomes? As we said, other incomes could be gain on disposal, could be maybe discount received, it could be contract revenue, and some other revenue from other sources. So we have other incomes. From our question here, I have not seen any item of other incomes. So we are going to go direct and report expenses. Expenses. From our question, if you look at the question here, items of expenses, we have wages and salaries, we have selling expenses, we have loan interest, we have other operating expenses. So I will come here and I report first wages and salaries. Wages and salaries. Wages and salaries. The figure for wages and salaries is 58. We saw it was 58, 800. Then we saw selling expenses. Selling expenses. Here. Selling expenses is 22,600. The figure here. 22,600. Then we have other operating expenses, and the figure is 17,700, like that. So those are the expenses that we have now. But remember, we have items that need to be depreciated, and they do not tell us to charge depreciation for either maybe operating expenses. Therefore, we are going to report depreciation as an isolated line of expenses. So we shall report depreciation here, and we have depreciation on property, but also on equipment. Now, what did they tell us? Let's go back. Depreciation on property is 1.5% per annum using the straight line method. 1.5% let us indicate it here, 1.5% of what? We are saying straight line, meaning we are going to subtract 1.5 on cost of property. And property here, the cost, the original cost is 120,000. So here we are going to get 120,000. That is straight line every year. That is what the company suffers as depreciation. And 1.5 of that you get 1800. That is for property. Now for equipment, they told us that the equipment is depreciated 25% per annum using reducing balance method. So if you can remember how what we discussed in the session of depreciation, we said reducing balance, the rate is charged at the net book value at the beginning of the year. So we look at what was the net book value when there was starting. Then we charge depreciation 25%. So now we are going to first get the cost here, which is 80,000. 80 less the accumulated depreciation that was reported to us here. Property 20,000. Equipment 38. So we are going to less 38 such that we can get the net book value at the start of the year. So on this, it is where we shall charge 25%. 5% of that. That is how they can use this. Good. So I can now compute using a calculator and I get a depreciation here. Now when I use my calculator here, I can see that I have 10500. This one is a comma like that. So those are my total expenses. Now I'm going now to use a calculator to total them up such that I can get the profit before interest and the tax. So when I add here, I get the operating. No. I get the total here. And get the total. It's the 8,800 plus 22,600 plus 17,700 plus 1,800 plus 10,500. And as I can see that you get 111,400. Like that. So this figure is total what? Total expenses. I am lessing it from the figure we got here, gross profit 159,200. I'm lessing 1 and I can see I am getting the operating profits. Oh, we said that is profit before interest and tax of 47 800. 800. That is the profit before interest and tax. No. That is profit. Yeah, for profit before interest and tax. So on this one, we are going to raise finance costs. Finance cost. Our finance cost from the question was the loan interest 5100. Loan interest was 510. 5100. So we are ready to put it in brackets. Putting it in brackets means we are raising it. So what do we get? What we get is profit before tax. So when we raise 5-1, what we get here, you have 42700. That is profit before tax. So on that you raise tax expense, of course, but here in the question we are not given the rate. We are not given the tax rate. So now that is how you prepare the income statement. So this is the profit. So you can see now that it is showing the financial performance by getting all the incomes, the sales, and what they incurred as cost of sales. Here you can see that they have the gross profit here. We got the gross profit. Then on the gross profit we less expenses. Like that. You can see eventually that we have the profit before interest and tax. Then when we raise the finance cost or the interest expense, we eventually get the profit before tax. So on this, it is where this one is subjected to the tax rate of the country to get the income tax expense. If you raise it from profit before tax, you eventually get the profit after tax, and that one is what is taken to retained earnings. But for practice purposes, for us to retain earnings, we shall take this one. We shall take this one because we are not told how much we should charge as tax. So members, if you find that this video is important, or if you see that it's valuable, please hit the subscription such that whenever we share any content of knowledge, you're able to be notified. See you in the next session when we shall be talking about the balance sheet, the preparation of the statement of financial position. Thank you so much. May God bless you.